Hello to all traders. Good evening to everybody, wherever you're watching us from today. And welcome to this monthly engagement for our non-farm payrolls. Today it is Friday, the 3rd of April. And we seem to have actually the most interesting NFP that there's ever been in the history of the NFP and also in the history of the markets. Before we start, I need to read you a risk disclaimer. Forex and change trading and investment derivatives can be highly speculative, may result in losses as well as profits. Foreign exchange derivatives trading is not suitable for many members of the public and only risk capital should be applied. This webinar is provided for information purposes only. No information contained herein constitutes a solicitation for the purpose of the purchase or sale of any commodity, security or investment, nor should it serve as the basis for an investment decision. Orbex Ltd does not guarantee the accuracy or completeness of any information or analysis supplied. As usual, we are going to start with the Nfp Preview today. Okay, so we're going to talk about the analysts' expectations. Okay. And then, of course, we're going to see whether those expectations, we're going to talk about whether those expectations are realistic. And then after mentioning a couple of good pointers for risk management, we're going to go, of course, ahead on our charts to do some pretty quick, to be honest, analysis there, because it doesn't need to be anything more than done during high volatile and liquid new releases. And we will analyze pairs that we find most interesting, as well as the ones, of course, that are likely to move most. And we're going to analyze, of course, we're going to examine how we can identify those. Now, as you can see, this NFP is expected to come out at 163,000 jobs, right? This is, of course, from the previous forecast of 161 as well, right? Last month, we had 273,000 coming up. Obviously, this is a 112,000 divergence, right? Which is huge, to be honest. It was a very upbeat report last month. Okay, now this month we're expecting a decrease from 273, right, to 163. This is again a huge decrease. It's pretty much what the increase was from last month, what the divergence was. It's supposed to be covered. Now, the forecasts are pointing to a weaker jobs report when looking at the trend, of course, and also if we take into consideration the last 6 month average, which I assume just by looking at these numbers comes around the 200 or so, 200 barrier. So we're looking at 161, right? 163, excuse me. So fairly below the average, around 40,000, let's just say. But should we really look at that, or we should really just focus on the current situation? And right, what is the current situation? What does the current situation tell us? Well, everybody is aware about how the coronavirus is affecting the jobs markets. Not only, of course, it affects everything, but the jobs markets as well. We've seen the unemployment claims, consistently hitting new records. I think we currently have around 6.5 million people in the US that they have filed for insurance claim, right? This is a huge number. And then you might turn back and ask, why are we really expecting 160,000? I mean, are the economists out of their mind or what? What is going on? Guys, the truth is that this number was forecasted weeks ago, right? And now, if we take into consideration that the NFP, the data, that how they are calculated pretty much, right? They count up to the 12th of March, if I'm not mistaken, right? So we're only talking about barely, having an effect due to the coronavirus on this NFP. So my thinking is that we have to go on the current situation as it stands, which means not the current environment, but what data are we really looking to compile that the actual forecast has been compiled with, to be more precise, right? So the 160K jobs isn't far from what we're going to get, in my opinion. Okay, we might get a miss. It's still going to be a big decline from the previous one. We might get a miss, but anything And as I've been saying repeatedly on my webinars, anything above 40K should be really considered anything that can move the markets, right? Anything below, it can just be very, very short term, okay? And at the same time, of course, it depends on the rest of the data set, which is the unemployment rate and the average earnings. Now, let's go on the next page and look at the analysts' expectations a little bit deeper, right? So the unemployment rate was at 3.5, expected to come at 3.5, right? Now, the expectations are neutral at 3.5, right? Now, in February, analysts had estimated an unemployment rate of 3.6, and they missed expectations, of course, at 3.5, right? Now, the hourly earnings also deteriorated. We went from 0.3 to 0.1, and that was owed to mainly manufacturing recession, okay? And that doesn't necessarily come into play because of the coronavirus. It's obviously affected because China was the first one to be hit pretty much, but it was coming also from the trade war narratives, right? Now, the previous month, it was up by 20 basis points, okay? It was 0.1 and came out 0.3, but again, it missed expectations of 0.5. In my opinion, that expectation was too high, but this month at 0.1, I don't think it's far from what we're going to get. The thing is that obviously average hourly earnings are supposed to be affected by the coronavirus, but as I said before, the report isn't covering much of the coronavirus time span. Right now, yearly wages are expected to remain below 3%, below the 3%. Yes, year-on-year target of 2.9, but they beat the monthly estimate last month, right? So with lower rates now, it will be interesting to see when the inflation will start turning higher. Now, don't forget, obviously, that the prices of oil are very, very, very low. So how are we going to get inflation moving higher? Well, the other way to get inflation moving higher is by lowering interest rates. As you all know, the interest rates are very, very, very low worldwide, right? Are very low. So that suggests that we might have some trouble getting the inflation peaking, okay, at any point soon. Now, let me just go quickly onto the next slide. And this is the Nfp preview. I mean, we really want to look at what indicators we need to consider, right? And this is economic indicators. We need to consider when we are looking at the Nfp from an economic perspective rather than anything else, right? So there is two different types, of course, right? There is lagging indicators and leading indicators, right? And we always need to look at those if we want to at least have an idea of how this Nfp is going to be, what are the estimates pretty much. We need to have an estimate in mind, right? Usually we'll see retail traders just going to trade in depending on the result, right? But there is also different strategies that they are used out there, right? Which suggest that you know pretty much, you have a rough idea about what's going to happen ahead of the Nfp, right? This is what we are examining right now. So lagging is the ISM manufacturing, non-manufacturing, the challenger job cards, and also the jobless claims, the ADP non-farm employment report, consumer confidence, consumer confidence, and also ADP non-farm employment report, which was out last week, by the way. Now, leading indicators, we're looking at treasury yields as well as equities, okay? And now when we're looking at leading indicators again, we really need to also pay attention on the crude oil prices, right? What's really happening, and that is what's happening during the day and before the NFP, right? Now, on the next page, what I have done, and as I always actually do, I've put together the pros and the cons of those particular indicators that we are interested in looking. Now, the ISM manufacturing, I didn't add it obviously here because it's this Friday is coming out after the NFP, right? So the rest of the data, we have the ISM manufacturing, which is, let me just get the pen again, 1 second. So we've got the ISM manufacturing, which is actually was released better than expectations last time, right? The employment component was negative, however, right? And this is not a good sign. Challenger job cuts, nearly a record high at 222,000 jobs cut. Now, the last time that was as high, it was just before the 2008 financial crisis. Jobless claims, it's about 6.5 million, okay, a huge number, also negative. The ADP at minus 25,000K, they were expecting minus 150, that's why it's supposed to be on the positive side. It didn't go as bad as expected. And that is because as well, again, it doesn't take into consideration much of the data of the affected economies, or the US pretty much, because that's what we're talking about today. Now, the University of Michigan consumer sentiment is another one. Came out positive compared to the forecast, but lower than the previous figure. That's the same with the CB consumer confidence from 115 to 120, but much lower than the last one. Now, core retail sales, obviously as expected, at minus 0.5. The US was expecting 0.2. Obviously, that didn't come through. From last month, we had, that's like 100, nearly 100 points decline. Now, we have the live, also the leading indicators as we're talking about, which is treasury yields, equities, and the crude oil. Treasury yields are down for the day. Equities are up and crude oil is up as well, right? So what does this tell us? Now, the relationship is that when treasury yields are down on the day, this is supposed to be seen as a negative for the NFP. So markets are expecting a worse number than what the economists have projected, right? So that pretty much tells us that we're not going to get the 162, is it? 161,000 added jobs that economists had projected, but we're going to get something lower. Now, the equities and the crude on the other side, right? They are showing something different, okay? Because there are leading indicators again. So we have, as you can see, mixed data here, mixed signals, right? So it's definitely a complicated NFP, but the thing is that, in my opinion, it's going to be very, 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 very volatile. Now, if I recall, the last month's NFP was nearly like it moved the markets maximum 30 pips, right? So this is not going to be this case this time. So on to the next page, on the next slide, what else we can do now is go quickly and assess what's happening in the interest rates, because usually, and as we've talked about that, actually, we talked about this every month. When we pick a pair, we need to look at interest rate differentials, because in the long term, the economic effects, of course, are affecting the jobs markets. Then the jobs markets are obviously going to affect consumer spending, retail sales, and consumer confidence, and other actual indicators. So between countries, we need to look at interest rate differentials. Now, as usual, Switzerland is at 0 minus 75, right? So with United States, Canada, Australia, New Zealand being at highs, right? These are the highest ones. Then when we need to look at any of those pairs, obviously it's a US based release. So USD against the CHF franc is a very good option to trade if the NFP is positive, okay? Now, in case the NFP is negative, what we need to do is go and trade the one that is the strongest against the dollar, right? Which one would it be in this case? It would be USD CAD sell, would be an Aussie dollar buy, or Kiwi, New Zealand dollar buy as well, right? So if we keep that in mind, and then we'll go on to the next slide to see which currencies are actually currently trading weaker or stronger against others, then we'll be able to pile that down, you know, and pick a certain pair to go for the day. Now, despite all that, of course, right, we can still go for euro dollar and dollar yen, right, as always, because they are the most volatile, they are the most liquid ones. But however, here's what I'm saying, right? So this is the currency meter for the pairs, for all the currencies, actually, most of the currencies. And in this morning, actually just an hour ago, if I'm not mistaken, I was looking at this, and what I can see, of course, is that the dollar is quite strong, right? The Canadian dollar is quite strong. And what is very weak is the Aussie, right? So in case the NFP comes actually positive, what I wanted to do in this scenario, okay, we have Aussie against the dollar. Dollar is strong, Aussie is weak. What's going to happen? Well, we can sell Aussie dollar, correct? However, Aussie is got same interest rates with the US, right? Don't forget that. The other one, the Canadian dollar, is very strong against the relative pairs, but also is the second stronger against the USD. So in case the NFP comes out worst, okay, what can I do? I can sell USD CAD, right? Because the Canadian dollar is actually strong against the dollar. The Aussie dollar is weak against the dollar. So these are the two pairs I would be looking for the day, okay, to trade. But as I said, again, euro dollar always and dollar yen. Now, before we go into the charts, if you don't have experience in trading the NFP, just avoid trading because the volatility is very high, okay? Now, in case you decide to go in, apply protective stop and take profit. Risk management always in order to bypass any emotional hurdles. Close out of all positions if you know, if you're not winning or losing much in an attempt to divert from high volatility. Hedge your positions if you are aware how to hedge, obviously, if you know how to hedge. If you still are eager to trade but you want to avoid any risk, just let the market settle down a little bit and go for it after, right? And this is always the best solution for me, because once the data are actually out, we can analyze them. We'll have like 10, 15, even 30 minutes to analyze them and then understand the post-effectual events and the bias and trade accordingly. As I said before, anything that is below 30K is not really considered much effective in terms of divergence, right? Now, what I will do, I will go quickly on our charts, right? So we talked about euro dollar, dollar yen. We're gonna see Aussie dollar and also dollar CAD, right? So why don't we just make this layout quickly with those four pairs, right? So that we can have a quick look on these particular markets. Here we can add the dollar card. Yeah, okay, we're good. And here we can add the Aussie dollar. Okay. Now, what do we really want to do is the simplest thing that we can do is start drawing support and resistance levels in order to, of course, identify entry levels and exit levels. Okay, this is the easiest way to always do it. There's nothing else that really matters during the NFP, right? At least it really depends on your strategy if you're long-term or short-term, but I guess you get the point. Okay, so that's for the euro dollar. Okay, so we've got both on the upside and downside, we've got the entry levels and the exit levels. Now on dollar yen, we are on the 1 hour chart, right? As always. Again, let me just delete those actually. I would like to use that. Yeah, very, very, very indecisive on the 1 hour, the dollar yen. Exit. Okay, a top, and that's not really giving us much of an entry. Could be even down here. We're on the 1 hour, so that shouldn't be a problem. There's still a few pips away, right? That's what I'm saying. So let's go closer on that one too. The next one, let's lose this. We don't want that. This is the dollar card. So on dollar card, this is the one. This is another one to draw. Very good activity level, which is also can be used for an entry, exit, exit, and on the upside, we've got the entry already there, exit 1, exit 2, and for the brave ones, exit 3. Yeah. And on the downside, the same. For the brave ones, exit 3. Again, we are here on the 1 hour chart. And the last one we want to look is the Aussie dollar. Now, sometimes we need to just zoom a little bit further out in order to get some good levels, right? Because in the short term, sometimes we might not be able to see what is really happening in the markets, right? So again, on the upside, that is a good entry level, right? Exit 1 on the downside zone, 1 on the upside of this zone, okay? It's a support resistance zone. On the downside, well, this would be an entry, and an exit could be, I mean, this over here ideally, but if we go a little bit closer, we might realize that from 59.83, that's 10 pips out, 10 pips away from the current price. And then the 40 something is 50 pips away, right? So that might be a bit overextended. So what we want to do, we're going to also go ahead and draw another level between those two, so right? The highest activity one. Okay, so this is the simplest way and the one that actually always works, right? To draw entry and exit points, guys. There is nothing else to it. But, you know, don't forget that we have a very highly volatile market at this moment, right? So there is nothing else to do, to be honest. So guys, if there is anything else in particular that you wanted to actually analyze, we can quickly go and have a look. You just need to just let me know, right? So we are expecting, let me just actually get the results out as well, the economic calendar. There we go. Okay, so we are here. I'm not sure how I'm going to fit everything. Let me just make another attempt over here. I will just drag those a little bit further back and bring that back on. There we go. So 3.5, we might see that going to 3.6. Okay, I'm not expecting a big jump on the a big drop on the NFP. The average hourly earnings might also move to the downside. We might see a stalemate there. We might see those moving down to zero or not. Okay, we can never know what to expect, but don't let the situation around the current economic conditions, okay, pretty much influence your expectations, to be honest, because all those estimates were done back in the beginning of March, just before the middle of March. So in the US, the cases weren't even many back then, okay? I mean, I don't know how many there were back then, to be honest, but I'm just saying that there weren't many. So the next NFP is the one that is going to be very, 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 very bad for the US economy. But then again, don't forget that these economic events are traded against expectations, right? Not against the previous ones. So if expectations in the next month, right, are for minus 150,000 and it comes to minus 120,000, it will be considered a good NFP, right? Do not forget that. So the time is already, no, we're actually 2 minutes out, right? So we still have 2 minutes to wait. However, we'll see which one is this. This is the dollar yen. The dollar yen is already moving a little bit down, right? That would have triggered an entry over here, okay? That's the truth. Maybe a good idea to have something between as well, because that looks a bit far from the current price, okay? So it's always good to have multiple levels, right? Take profit as well as stop loss. Stop loss, shouldn't be too far from your entry. Obviously, you need to give space for the trade to play out, So we've got euro, dollar over here, dollar yen, dollar CAD, and also the Aussie against the dollar. We are seeing the economic data currently loading. The dollar CAD is already pushing down. That would again have triggered our entry over here. Dollar yen is going before anything else. It's just moving. Oh, wow. There we go. This is a huge down bit for the NFP, right? And I'm surprised, to be honest. I'm very surprised, because this was not supposed to be the case. If we consider that the data were actually taken on the 12th of March. This is very weird. Obviously, you can see we had about 6.5 million people submitting their insurance claims. Okay, out of this is like 10% of those looks like lost their job before the March 12th. This is what these report is suggesting. I mean, it seems a bit unrealistic to me, to be honest. Obviously, unemployment rate at 4.4, it would go much higher, of course, but I was expecting all these numbers to come out next month, not this month. Now, the average hourly earnings surprisingly moved up. Okay, it might be that the loss of employees is actually causing early earnings to go up. Now, dollar yen has taken out the first take profit level and swiftly moved all the way back. Okay, because I mean, we do not know because, but it's because it's a volatile report, of course, and there is a huge divergence, and this volatility is causing, of course, is triggering a lot of orders, whether they are on the upside or downside, a lot of block orders that are very, very, very big for the common retail trader, right? We're talking about billions that are traded over here, right? Now, dollar yen is not moving much. I mean, we are from the current entry level, we moved like we didn't move at all, to be honest, from the current level. It's just that we had this move to the upside on the hour, right? Here's what I'm going to do. Let's go down on the 30 minutes. So we see the actual move. Okay, there we go. The 30 minutes helps more because the release is on the half past rather than on the hour close, right? Okay, so Aussie dollar is falling. Okay, euro dollar is falling. Dollar yen is going up. Dollar CAD is going up. Okay, which is rather awkward, given, of course, the results, right? Let me just go back onto that. So, non-farm payrolls, let us refresh quickly. One second, let's just refresh one more. There we go. So if we go back on this non-farm payrolls, okay, minus 700,000 jobs. Participation rate didn't fall much, to be honest, at 62.7. But this really, what strikes me is this. Going up to 0.4 and average hourly earnings are 2.9. I mean, it's rather odd. Now, I mean, I am surprised, but in these markets, nothing should surprise us, right? This is the truth. This is the truth. Nothing should surprise us in these markets. Now, what we are likely to see from here on, right? You may ask, are we going to see the dollar continuing going higher or, pushing prices lower as it should be because the NFP was a nightmare? Well, we never know that. But as I was saying before, because during these times it's very hard to trade and there is a lot of whipshots that are expected. I mean, already we have had a lot of levels being taken out over here, whether there are entry points or stop loss, right? Look at this, dollar CAD is moving down. Okay, we said that the Canadian dollar is strong against the dollar, didn't we? Here it is. Canadian dollar is strong against the USD, so that would be the one to trade. Of course, the Swiss franc as well, right? in case the report came out worse than expected. Isn't it what we said? It is what we said. And since the Canadian dollar over here has a similar, actually identical interest rate with the US, whereas in this case, the Swiss franc, Switzerland has a negative one, then we prefer the dollar CAD, right? That's why we wanted to trade it, isn't it? So again, Aussie dollar on the other side, as I said, Aussie is weak. Okay, we said it's weak. Well, it moved down, to be honest. Now, where we're gonna see this going, I'm not sure, obviously, but I don't think we're gonna see it moving much, to be honest. Okay, it looks like it's going to be a shadow NFP again. I mean, on Aussie dollar, we've had 59.80 and 61. This is like 30 pips, right? Dollar yen moved a bit from 108.24 low, 108.56, let's say, 30 pips again, right? Euro dollar from the beginning of the half hour down to here is 25 pips, 30, maximum 30 pips, right? Dollar CAD on the other hand, from 41.80, yes, 85 to 41.35, let's just say, right? It's the only one that actually had a good, let's say it's the most volatile, I would just say in this case, because these price swings are indicative of high volatility, right? We're talking about potentially like nearly 50 pips over here on the dollar CAD, okay, which is the only one. What if instead of Aussie dollar, because it's very boring, let's just have a look on GBP USD. We went from 1 to 22. This is again 30 pips. Gold from the 1611. Well, nearly, actually, gold is doing pretty well, right? It went up at least $10 from the low, right? And can be expected to move higher, of course. Now, don't forget something else. I mean, particularly for the gold, right? You will see that this relationship between Euro USD and gold, right, is not really showing any good correlation at the moment, right? I mean, obviously, we haven't seen the correlation. The correlation is broken over the past few weeks. We're expecting gold to move higher because of the risk in the economies, okay, due to the coronavirus. We're expecting gold to move higher because of Brexit. We're expecting gold to move higher because of US trade wars. We're expecting gold to move higher because of the geopolitical risks in the Gulf region. Has gold moved higher? Where it did move higher on certain events, but the moment we all expected for the gold to move higher due to the coronavirus, gold fell. That is purely because all the other markets fell and institutions lost money. So they had to rebalance their portfolios, and they had to take some cash to cover their positions, to hedge their positions, and that was the only reason the gold actually fell. Now, with that being said, right, if we look what's happening here between Euro USD and gold, there is no correlation at all. I mean, there's nothing to see over between the two. What I want to mention though is that we've seen these move to the upside over here, right? Over the past few hours, right? Moving up. That means institutions were buying gold ahead of time. Okay. Now, what is this? Is this because it's like the so-called priced in event? Or is this because gold is going to move up anyway, and you know, knowing that there's going to be a bad NFP, because the NFP would be bad anyway, they just start accumulating from down here. I mean, the accumulation started, you know, from a different point down here. If we just take the 30-minute, I mean, this is a good accumulation from up here, to be honest, right? We broke above this high as well, right? Now, for gold, what we really want to see is prices really going up back here, right, to the 1637 to assume a further move to the upside, right? But as I said, we are in a very, very risky period at the moment, a high uncertainty around everything, okay? But I want to tell you this for sure, that when this thing starts deteriorating, the coronavirus, that doesn't necessarily mean gold will go down or gold will go up. Gold is supposedly going to move up because of interest rates, okay? They are very, very, very low. And the question though is here, are we gonna go into a depression or a recession? Are we in a recession? Well, in my opinion, we are. Because if things are going to get worse, this would mean that this is going to be deflation, right? And risks of for gold moving higher are quite lower. Now, as you can see, dollar CAD is making the move, okay? Well, we're expecting this to happen anyway. We have our current take profit at 41.26.8. Okay, our entry was up here supposedly, right? Is this going to be taken out? It's very likely. Okay. The second one, I'm not sure. I mean, we can never be sure. That is the reason that we need to play it at least as safe as we can. Okay. I've got a questions here about how to trade the NFP, buy stop, sell stop orders. There is two different things that you can do, Alexandria. Setting pending orders has its benefits, but also has its disadvantages, right? Because you could get issues with slippage if you have a pending order, or you could actually get into a position that suddenly you had to change the entry point or the exit point. So it really depends on your strategy, okay? And this is not, I mean, having pending orders, it was one of the strategy ideas over here that we discussed, right? So if we go back here, you know, let the markets calm down, of course, hedge the positions ahead of the release. So that would be a way of hedging for me, because you can enter the markets with pending orders, okay? And once your levels are reached, then trades opened, then trades closed, either on the winning side or on the losing side. You are free of any psychological risks in case you do that. And if that works for you, you know, if you, I mean, not you specifically, but if traders are a bit more emotional when trading, because there is such type, actually 90% I would say of the retail trade community, then it might be a better idea to set up pending orders. But for your pending orders, that's the thing, you do not really want to go far from the actual event itself, right? I mean, you have to place them a few minutes before, because as I said before, a sudden move in the markets, and they are very well expected, a sudden move could trigger your order accidentally, and an order that you probably wouldn't want to have in, or maybe you would, but why leave that, you know, to fate? Now, that level actually was reached, okay? It came exactly there. And now prices are again moving up higher. I don't see, I mean, even what was this, gold, okay? Even gold is boring. I mean, most of the pairs are boring. Now look at this. The Swiss franc seems to be weaker than the yen, okay? And then you may ask, are we supposed to expect that? Yes, we are. At least in this current market. You know why? Because of this. Because Swiss interest rates are minus 0.75. In Japan, they are minus 0.1. Okay, so interest rate differentials here are playing their role. Okay, we can see this clearly. Now this is, I'm not gonna, okay, let's just see again the pound. Let's see what's happening on the pound. Pound, okay, so this is a little bit of a weaker dollar over here. That's why we see these three. But the Canadian dollar is also strong. Don't forget the Canadian employment report is not due today. It's due on next Thursday. Okay, it's new next Thursday. So we had a look at the Aussie, right? Let's have a look at the Kiwi. Kiwi is a bit weaker, right, than the Aussie. We can see that over at least in the 30-minute. It's just a tiny bit though. But what I'm interested to see is what's happening with euro pound as well. So you see that the euro at this current market is stronger than the pound. And what does this tell us? This tells us that we see some flows here on the euro dollar owed to dollar selling, right? But there is more dollar selling against the euro rather than against the pound, which is very obvious because euro pound is moving up, right? Obviously, that can be expected sometimes, but sometimes not. But to me, it seems that at the moment, euro, there is more inflows and outflows between the US and the EU. Okay. I mean, it's Friday today anyway. We're still expecting the ISM report from the US, and it could have an impact in the markets depending on the result itself. Now, let's have a quick look on the oil. Oil is also moving up, right? I mean, we've had Trump's tweet yesterday. I mean, not that he knows anything, but well, it seems that the markets have taken that a bit warm, and they are buying the oil, hoping that the Saudi Arabia and OPEC Plus will start, cutting production. But there was no agreement on that. There was no announcement from OPEC. It was just Trump going out on his Twitter. Now let's compare that with the S&P. Okay, you see, the S&P had a move down, right? So it's quite volatile compared to the oil, right? So the S&P is moving up indeed, but the jobs report wasn't good, was it? It was very bad. And the average hourly earnings were pretty good, which means the companies will have to pay more, to employees. So that would also bring that down. But then unemployment went up. The move on to the employment, I mean, the difference, the gap there is like 700,000 jobs, right? It's huge. I mean, it's the number is breaking any records that we have seen before. Obviously, these records were done back, let's say, in the Depression time, the 1930s or so. We cannot really compare then and now because back then we've had, the population obviously was much, the numbers were much smaller than they are now. We are like billions now. I mean, I'm not sure what's population in the US, but obviously the employment sector was much smaller nearly 100 years ago compared to now. So although history is good to forecast sometimes, we are in a period right now where we write history, right? So we can look in the past to see how people and markets have reacted. But in my opinion, since we are setting new records now, this is the time where we can start taking notes for the next big event, because this is now what we should be looking for the future, right? We still have a few minutes to go. So guys, if you have any questions, I am free to and available, of course, to take any questions, of course, related to the current condition, right? Economic conditions or job market specifically. Now, from the S&P, what's happening with the dollar against the Chinese yuan? It's going up. Okay, so it seems that Chinese yuan is quite weak at the moment. Yen is losing stream. Swiss franc as well. And we're again on the 30 minutes, right? Now, guys, I mean, as we talked about the last slide, there is a good way of understanding where the market is going to go after such an event, but this would require better volumes, better trading volumes from what we see today, because the moves are not as big. I mean, I was expecting much more, to be honest, this time, specifically if we take into consideration these big divergences, but we don't see anything that's really worth trading apart the dollar card, right? Now, there is a few things what we can do after the hourly candle has closed. It's 3:52 local time now. In 8 minutes, we're going to get a candle close, right? Now, this, if you have followed our TLAB, Trading Like a Banker exclusive webinars, we talked about the DCB. The DCB is the dead cat bounce, right? So what usually happens after the hourly candle closes, let me just go on the 1 hour on dollar cut, for example, because this is a good drop, right? We're looking at a dead cat bounce. The dead cat bounce means that's going to have prices falling and then something like this. Okay, a dead cat bounce. Now, it looks like markets are pushing down for the 141.13. Okay, I mean, we don't know we're going to get there, but it's very possible. Now, back to the hourly candle, right? What is the case over here is that we need to pull our Fibonacci retracement, right? I don't want to go up here. I don't even want to go up here, okay? I want to go on the high of this candle, okay? And I want to draw my Fibonacci down to the low, which is currently this level. And then what I want to do, I want to pull the 50 Fibonacci over here, right? Usually, when we get a dead cat bounce, what happens is that the markets fall, right? The markets fall, and then they come up to the 50, and then they bounce pretty much, dead cat bounce, right? And then once they get there, you know, usually since the NFP is very bad, that would actually cause another move to the downside after a successive break of this move over here, right? But this can be a reversal trade up to the 50. Yes, and then once we break below that level and we'll hit this trend line again, we can trigger another sell with target the 41 and then the 40. Actually, the second target will be the 41 exactly, okay, which is over here. You can see it, and then so we'll have 3 targets over here, right? TP1, TP2, TP3. I mean, I'm not sure how you guys trade, but I mean, it's most of the people will just have 1 target, which to me seems a little bit, you know, I mean, it's like you leave money on the table when you're making a good trade, and then at the same time, you are losing much more money than you would in case the trade goes against you after particularly very easily reached level. Because what usually happens is that you have, let's say you buy over here, markets go up to there, you buy here, and then they turn against you. Well, your stop loss is here, is going to stop you out. Obviously, you use $100, let's suppose, right? But can you imagine if you had to take profit 1 over here, the moment you take this level, before you reach here, the moment you take this level, you move your stop loss to break even, okay? And it's very simple technique. Not only you've managed to pocket a few bucks, right? But on the loss, you're risk-free, you see? I mean, if you don't know these techniques, obviously we have done a lot of webinars, so do not hesitate to send me a message for more details. Now, which one is this? It's moving up. USD-CHF, yes. So you see the safe havens are losing. Let's see what's happening with gold. It's also falling, okay? So risk is back on. S&P should be going up relatively. Okay, so some flows are actually moved around at this moment as we speak. Okay, now here on the oil, do not assume that this is going to move higher. Okay, do not forget, guys, a Trump tweet doesn't mean anything apart from the short term. Okay, this is a good level, right? Look at this. Okay, so this over here could just be a simple bounce, and then we might be looking for price to move lower again. We don't know that, but let me tell you this. There is still oil price war. Oil prices are very low. Plus, there is no announcement from OPEC Plus. Okay, if there is an announcement from OPEC Plus for cutting production, then this will continue higher. But it's not going to necessarily last again because we have the coronavirus concerns, right? Demand for oil is very low and will remain low because we are on a lockdown, all of us. All industrial areas are closed. China starts reopening slowly, but China is one importer, and at the moment it imports very cheaply. Okay. Now I don't see any questions, so in case you do have any questions, please feel free to let me just go back on this here. Connect with me, send me a message on Twitter, LinkedIn, or even on my Instagram in case you remember something. So if you want to trade this, as I said before, it would be a good idea to wait for the markets to settle. A few more minutes for that, to be honest. The dead cat bounce is one idea. Another one is to wait for the dead cat bounce to retrace and then trade the continuation. Okay, this is also a very good opportunity, and this can be hours after the NFP itself. Okay, and it's more, of course, likely to be driven by institutions as well. So this would be a very good opportunity for a few. So I want to thank you for being with me for this month's NFP. Next month, I mean, I'm not sure yet. It looks like it's going to be on the 1st. Okay. The 1st of, that's May, so maybe bank holiday might be moved a week forward, might be on the 8th of May, but I will be sending the invites as usual. And I want to thank you for watching. I want to thank you for your questions, and I want to wish everybody to have a safe weekend at home.